Hi everyone, hope you're all doing well. Today we are tackling a really important financial reporting topic on IAS 16, which is also known as property, plant, and equipment. And we are going to be particularly discussing about the initial recognition of asset under this standard. All right, so talking about the initial recognition of asset on the baseline, it is very, very important to understand the criteria that is used to record an asset as property, plant, and equipment in the financial statements. For that purpose, it must meet three criteria that IAS 16 has stated. And let's just quickly go through them. Number one is control over the asset. It's extremely crucial that the asset that the entity is going to acquire, the entity must have control over the asset. And what do we mean by control? It means that we can decide, the entity can decide how the asset is used and can prevent others from using it. So the entity is subject to all the risk and rewards that the asset is going to provide to the owner, who is going to be the entity. So a company must have control over the asset. Number two, talking about the probable future economic benefits, the asset must contribute to generating income or cost savings in the future. One of the typical example that I could give you is when the entity is going to buy a piece of machinery for the purposes of enhancing the efficiency of business operations. So what will it do? When you enhance the efficiency of business operations, it is going to generate cost savings for you in the future, which in turn would be producing economic benefits for you. And I've also listed the examples for you to read to further understand what do we mean by each criteria. And the third criteria is the reliable measurement of cost, which means that the company must be able to determine the cost of acquiring the asset with reasonable accuracy, which means that when the company is going to assess all the relevant costs that are associated with that particular asset, there must not be uncertainty surrounding this area. And we are going to be discussing those relevant costs now. So, one of the examples would be if a company buys land for $500,000, the purchase price and all the related costs, such as legal fees, can be measured and recorded. Because if we have uncertainty around these areas, then the company will not be able to assess the true cost of the asset, and therefore, this uncertainty will also be reflected in our final accounts, which is not great for the business, and thus it will also affect the faithful and the relevant representation of the financial statements. So, what is included in the cost of property, plant, and equipment? Under IAS 16 property, plant, and equipment, the cost of an item of property, plant, and equipment includes all the costs. Uh, okay, includes all the costs directly attributable to bringing the asset to the location and condition. It's very important, location and condition necessary for it to be capable of operating in the manner intended by the management. So all those costs that entity has to incur in order to bring the asset to its working condition and location are going to be capitalized to the initial cost of the asset. All right, they all will be capitalized. Normally, when we are going to incur the costs in normal sense, we would think that those costs should be expensed, right? But for these assets, the costs specifically that we incur to bring the asset to its working location and condition must be capitalized. Number one, we have purchase price. That includes the purchase price of the asset, which is usually the list price of the asset, any import duties and non refundable purchase taxes, less trade discounts and rebates. So, this will be added, any import duties and non refundable purchase taxes, and trade discounts and rebate will be deducted. But now I'm also going to be talking a little bit about trade discounts and rebates. What are trade discounts? As we can see, trade discounts are going to be offered by suppliers on bulk purchases or to maintain long term business relationships. Okay. So, if you have purchased in bulk, or if the supplier wants to maintain the business relationships, you would be getting what we call trade discounts. And trade discounts are going to be deducted from the list price of the asset. Similarly, for rebates, what are rebates? These are going to be partial refunds that are going to be typically provided after the purchase after meeting specific conditions like achieving a certain volume of purchases within a given time period. So let's say if you have satisfied any criteria for rebates, then you will be also deducting those rebates from the list price of the asset. So let's look at one example. A company purchases machines worth 50,000 in a year. So what is this 50,000? This is a list price. All right. The supplier offers a 5% rebate if purchases exceed 40,000. And clearly, the purchases have exceeded because we have purchased 50,000 worth of machines. And if your purchases exceed 40,000, then you will get a 5% rebate. So the rebate would be calculated as 5% of 50,000, and you get 2,500 of the rebate. This rebate of 2,500 will be deducted from the cost of the machine. And therefore, the final cost of the machine would look like this. You have 50,000, which was the initial list price of the asset, minus the 2,500. All right. And then you will have the final cost of the asset as $47,500. This is the cost of the asset which will be recorded. Moving on. What about cash discounts? Now, in your exam, you could be given cash discounts when you would be accounting for the initial cost of the asset. You must remember there's a difference between cash discount and trade discounts. Trade discounts, as we've just discussed, are the discounts offered by the suppliers on bulk purchases to maintain long-term business relationship. But what are cash discounts? Cash discounts are given when prompt payment is made to the supplier, which improves cash inflow for the supplier. Cash discounts are not deducted from the purchase price of property, plant, and equipment. It's very, very important. Cash discounts are not accounted as deduction from the initial price of the asset because cash discounts are recognized as finance income in your profit or loss account. Cash discount is related with financing, not purchase price of the asset. It's extremely crucial because cash discount is like saying that if you're going to pay within a specific time period, then you're going to get that kind of discount. So that discount generates saving for the business. That means that the business decides, okay, we are going to avail the cash discount, and that cash discount is going to be generating saving. That saving is incurred as finance income for the business. It's recorded as finance income. Trade discounts are tied to the purchase price and directly affect the asset's acquisition cost. But when we are talking about cash discounts, they are related to the method and timing of payment, which does not alter the asset's acquisition cost. Because the reason is if I'm not paying within a specific time period, then I will have to pay the amount which is equal to the list price of the asset, isn't it? I will pay. But if I avail the discount, the value of the asset will still be equal to the list price of the asset, but that the deduction now that has occurred because of the cash discount will be recorded as the finance income. It will not reduce the list price of the asset. It will not reduce the value of the asset in my books. Let's look at the example. Here is the example. Let's look at it. Example of cash discount and treatment of IAS 16. We have a scenario in which the list price of property, plant, and equipment is 50,000. And we have now got the trade discount. And just now we have seen the trade discount is going to be deducted from the list price of the asset. And once we deduct the 10%, this is the net cost which will be recorded, which should be typically recorded, less trade discount. This is going to be the value of the asset. But let's see, maybe we have some more things to account for. And the next statement says that we have a payment term that you will get 2% cash discount if you pay within 10 days. Now, this is upon the business, whether we want to pay or whether we don't want to pay. If we decide to pay, the cash discount will be recorded as finance income. If we do not decide to pay, then you will have the same cash outflow as the net cost of the asset. Now, let's look at what happens when cash discount is availed. When the cash discount is availed, the only thing that is going to change is the amount that we need to pay, because cash discount is not going to affect the value of your asset. The value of the asset is this 45,000. This is the value of the asset because trade discount has impacted the value of the asset, just like we have talked about right now. But cash discount is not going to affect the value of the asset. It is only going to affect the amount which you're going to pay. So let's say if we avail the cash discount, which is the payment we make it within 10 days, the cash discount will be 45,000. 2% of 45,000 is going to be your cash discount, because the term is that you are going to pay 2%. You will get 2% of cash discount, and 2% on what? On 45,000, which is the value of the asset after trade discount has been deducted. So you will take 2% of 45,000, which is this, and you will deduct it from the cost of the asset, which is 45,000, and you will now pay 44,100. Remember, this is not the new value of the asset. This is just the amount which you will have to pay. The value of the asset will stay 45,000, because just now we have seen cash discount will not affect the value of the asset. It just affects the cash outflow. So let's see. Now, based upon this, I know I will credit cash, right? Which is 44,100, which is my cash outflow. And just now I have told you that the value of the asset will stay the same as it was after the trade discount was deducted, which was 45,000. That is that. But we see that the debit and the credit is not balanced. Because we have paid less cash, where is the saving going to go? That saving is going to be recorded as your finance income, and this would be reducing your finance expense in the profit or loss statement. That discount is $900. This is how you account it as. That's all. This is what happens when cash discount happens. But if the cash discount is not availed, then what happens is that you will make the payment after 10 days. You will make full payment of 45,000, which is going to be the net cost of the asset after trade discount. 45,000, it will be simply debit property, plant and equipment at 45,000, which is recording of the asset, and credit cash or bank at 45,000. Now let's look at other costs that are going to be also forming the cost of the asset. They are going to be capitalized to the cost of the asset. So there are some of the examples of the costs that are directly attributable to bringing the assets to its working condition, such as cost of site preparation, initial delivery and handling cost, installation and assembly cost of testing whether the asset is functioning properly. Otherwise, how would you know if the asset is in its working condition? And professional fees that you may pay to architects and engineers to perhaps set up the location where you could install the asset. So these are all going to be the costs that are incurred to bring the asset to its working condition and location. All right, now we are going to be discussing another type of costs, which are going to be dismantling, removal, and restoration cost. And these are going to be slightly different in nature from the costs that you incur in present time to acquire the asset. So, for example, cost of site preparation, initial delivery, and handling cost, and all of these costs are going to be incurred in present time in order to acquire the asset and bring it to its working condition and location. But dismantling, removal, and restoration cost are all going to be the costs that are going to be incurred in the future. So, one of the examples could be that when you have acquired all the economic benefits from the asset and the asset has completed its useful life, you will then need to remove the asset from that particular location. And in order to remove the asset, you will incur some cost which are known as dismantling, removal, and restoration cost. These costs are going to be incurred in the future, but IAS 16 asks you to recognize those costs right now and add them to the cost of the asset. And this calculation of the cost is done under the standard of IAS 37 provision, contingent liabilities, and contingent assets. We are going to be discussing the calculation of dismantling costs right now, but you must understand that these costs are going to be forming the part of the initial cost of the asset. Then you will have borrowing costs. These are going to be the costs that are going to be incurred by the entity when the entity takes out a loan for the purposes of construction of the asset. So when that amount of loan is used to construct the asset, any borrowing cost incurred on that loan will also be capitalized to the cost of the asset. Normally, borrowing costs are going to be recognized as finance expense, but IAS 16 says that those costs are going to be also capitalized, which are directly attributable to the acquisition, construction, or production of a qualifying asset as per IAS 23 borrowing cost, which we will also be discussing in the future. And there are going to be also other costs that a company might incur, which are directly attributable to the acquisition or the construction of the asset. Depending upon the nature of those costs, we will also be capitalizing them. However, there are going to be some costs that are not going to be forming the part of property, plant, and equipment. And if you go through these costs on your own, you will understand that these costs are going to be the normal business operating expenses for the entity. So you do not need to capitalize these costs because these costs do not necessarily bring the asset to its working condition and location. These are just normal routine business costs that an entity might incur, which has nothing to do for the acquisition of the asset. Okay. So you must carefully in the exam look at the type of the costs that you're presented with to decide whether the cost is going to be capitalized or not. Now let's look at dismantling cost in detail. Dismantling costs are basically accounted for under IAS 37, which is provision. Basically, it means that for these kinds of costs, which have to be incurred in the future when the asset would be either sold or will be scrapped, what happens is that these are the costs associated with restoring the site where the asset was located. And these costs are going to be included in the cost of the asset right now. IAS 16 says that you will be recording those costs at present value. Why at present value? Because these are the costs that are going to be incurred in the future. So, considering the time value of the money, you will have to recognize them at the present value in today's terms. So, the dismantling provision, because we are going to be recognizing a provision. Provision, basically, another term means liability, and we have a liability to incur these costs in the future. It will start as a present value of the estimated future dismantling cost. Over time, the provision grows by periodic unwinding of the discount. Therefore, you will recognize the interest expense every single year so that by the time dismantling is due, the provision equals the future value, which is going to be the actual dismantling cost. Let's look at it now. So you come to know that you have a provision related to dismantling, removal, and restoration of the site. So you know that you have to recognize a provision. What will happen in the initial recognition is that the dismantling cost is capitalized as part of the property, plant, and equipment and recognizes provision at present value. And I will tell you how to calculate the present value. The journal entry would be debit non-current asset because you will capitalize that cost, and then correspondingly, you will recognize a dismantling provision, a non-current liability. Why is it a non-current liability? Because this is the cost which you will have to occur, for example, maybe in 5 years' time or maybe in 10 years' time. So it's not a current liability. It will rather be a non-current liability that you will have to settle in the future. So you recognize the provision and you debit non-current asset for the purposes of capitalizing that dismantling cost. Once you've recognized it as initial recognition, what happens then? You will then subsequently every year unwind that discount, which means that each year the provision increases due to the passage of time, reflecting the time value of money. This increased unwinding of the discount is recognized as finance cost in the profit or loss statement. So the journal entry would be debit finance cost that would be calculated by the discount rate that will be that will be given to you, and you will credit dismantling provision. You will increase that liability to reflect the time value of the money, and eventually every single year this liability will keep on increasing until it becomes equal to the future value which you will have to pay when the time of restoration or dismantling would come. And therefore, when the final time comes, final payment at the end of asset's useful life, the dismantling obligation is going to be settled. At this point, the accumulated provision should match the actual cost, assuming no changes in estimates, because if there is any change in the estimate, it will have to be reflected in the value of the provision. But at the end of the asset's useful life, the provision must be equal to the actual cost of dismantling or restoration. And therefore, you will pass the journal entry as debit dismantling provision because now you're removing that liability. It's no longer existing because you are now settling that liability, and you will credit cash or back because there is cash outflow to settle that liability. Now let's look at this example to further understand. Let's say the estimated dismantling cost in the future value is 100,000 and the time to dismantle is 10 years. Because it's non-current asset, we would not expect the dismantling cost to occur in 1 year. We would expect it to happen maybe 5, 10, or 20 years. The discount rate is 5%. What should be the initial recognition? You will discount this value to its present value. All right. And therefore, the present value is $61,391. How is it calculated? I will show you. You must note down that the value formula of the present value is going to be future value multiplied by 1 plus r, which is the discount rate raised to the power of minus n. Minus n is going to be the number of years that will for which you are calculating the present value. Therefore, the present value will be equal to 100,000 multiplied by 1 plus r, which is the discount rate, 5 divided by 100 minus 10. Please take a pause and put this into your calculator and tell me what is the answer. Once you calculate this, you will see that the answer is going to be $61,391. This is the present value. This is the present value of the cash outflow that will occur in the time of 10 years. And therefore, now you will recognize the provision under IAS 37. You will debit the property, plant, and equipment because, as we have just seen, this dismantling cost has to be capitalized to the cost of the asset. So this will be 61,391, and you will recognize a provision, the dismantling cost. Normally, it will be known as dismantling provision or dismantling cost. It will sit under your non-current liabilities in your statement of financial position as $61,391. Now, what happens is, for example, this provision is recognized as the start of the year. Okay? At the start of the year, you recognize this provision. At the end of the year, when the first year will be completed, we will unwind this discount. Which means you will take 5% of your present value, which is $3,070, and you will pass the journal entry to recognize this finance cost that will incur every year in relation to this provision, which is going to be debit finance cost, recognize expense, and credit dismantle provision. You will recognize the increase in the provision every year until it matches your future value of $100,000. So the liability grows over time, eventually reaching 100,000 by year 10. The finance cost is recognized in P&L annually. And in this way, you will be able to account for the dismantling cost under both IAS 16 and IAS 37. Where is IAS 16? IAS 16 says that the dismantling cost is going to be capitalized to the cost of the asset at present value. And IAS 37 says for that particular future cost is your liability. For that liability, you will have to recognize the provision. Let's start doing this question. It's a very simple MCQ, so it should not be difficult, but let's try it together. Now, before I do this question, I will recommend you to please take a break and do this question on your own before you play the video, and just try to assess yourself if you got something right or if you got something wrong. So, what should be included in the initial cost of the machine according to IAS 16? Let's read. ABC Limited purchased a machine for 50,000. What is this? This is going to be the list price. Okay. This is how much you are expected to pay to the supplier. The company incurred the following additional cost. Transportation cost? Yes or no? You tell me. Yes or no, will it be included in the cost of the asset or not? Yes, it will be included because these are the costs necessary to bring the asset to the location. Installation cost? Yes. Training cost for staff operating the machine? No, because this is your business expense. It is not something that is incurred to bring the asset to its working condition or location. This is your business headache. So, training costs for staff will not be capitalized to the cost of the asset. Annual maintenance contract? No. Why? Because this is going to be the cost associated with the repairs of the asset, and usually it will happen after the asset is brought to use. This is not the cost which you will have to incur in order to bring the asset to its working condition or location. So, what happens? Let's start. 50,000, you will add 2,000 of transportation cost plus 3,000 of installation cost, and 55,000 should be the total cost. So, as per this, our answer is B. All right, you will put B. Now, let's look at a question in slightly more detail. And as usual, please take a break, pause the video, and try to do the question yourself, and then just try to match your answer as we do this together. So, LMN Limited has constructed a factory building for a new production facility at a cost of 50 million. The following costs are incurred as part of setting up the facility. Site preparation, capitalized? Yes. Transportation cost? Yes. Installation of the machinery? Yes. Legal fees for obtaining planning permission? Yes. Otherwise, how would I plan and how would I know how to and when to install the asset? Right? Training cost of staff? No. Business headache. Estimated cost of dismantling the factory at the end of the useful life to be incurred in 10 years is 2 million? Yes. Discount rate? Yes, it will be helpful to calculate the present value of this dismantling cost. So, using the information provided, identify which of the above costs should be included in the initial cost of the factory building according to IAS 16. Select the cost that must be capitalized as part of the factory's initial cost, and we have already done that. Site preparation, transportation cost, installation, legal fees, all will be capitalized to 15 million. They will all be added to the 15 million. Let's calculate the present value of the dismantling cost so that we can capitalize this to the cost of the asset. It says calculate the present value, assuming it is to be incurred at the end of 10 years using a 5% discount rate. What amount should be added to the initial cost of the factory for the building for the dismantling cost? So, what is the future value? 2 million. Discount rate is 5%. How much is the time? 10 years. And I've already told you how do you calculate the present value? Is going to be equal to the future value multiplied by 1 plus r, which is going to be the discount rate raised to the power of minus n. This minus n is going to be the number of years. So present value is going to be equal to the 2 million multiplied by 1 plus 0.05. 0.05 is 5 divided by 100 minus how many years is that? 10. Once you put this into the calculator, what do you get? You will get 1.23 million. This is the present value. This is the amount which will be capitalized to the cost of the asset. Okay, so therefore, if I were to calculate the total cost that will be capitalized and I include also this dismantling provision, can you tell me what is going to be the total cost? Come on, do it yourself and let me know. The total cost would be 15 million added by 200,000, 50,000, 300,000, 40,000. And adding it with the provision, the total cost will be 16.820 million. This is going to be your answer. The total cost that will be capitalized to the cost of the asset. It's very, very important because even though the company is going to pay 15 million to the supplier, but you can see all of these costs that have to be capitalized as part of the asset in order to know the true cost of the asset and the property, plant, and equipment. Now, this is a complex question, and I want you to seriously do it yourself and then try to match with the answers we are going to discuss right now. So I'm waiting for you. Do it on your own and let me know what the answer is. Compare it with the answer we are going to discuss right now. All right. Hopefully, you have done the question by now. Let's just try to do it together and see how much of this you have got right. Okay. So DEF Limited has purchased and installed a manufacturing plant on the start of the year, which is 1st of January 2001, at a base cost of 20 million. In addition to this, the company has incurred the following cost: site clearing and preparation, yes, capitalized. So I will capitalize this cost. Transportation of plant components to the site, yes. Import duties and taxes, yes. Installation and testing of the plant, yes, it will be capitalized. Employee training on how to use the new plant, not my headache, will not be capitalized, it's the business's headache. So they will sort it out how much training they need, because this cost is not going to be incurred to bring the asset to its working location or condition. Estimated dismantling and restoration cost to be incurred in 12 years is 3 million with discount rate at 6% per annum. However, during installation, a minor accident caused damage to one of the machine components, and DEF Limited paid 250,000 to repair this damage before the plant was ready for use. Is this cost going to be capitalized or expensed? Now, I want you to read this very carefully. During installation, a minor accident caused damage to one of the machine components, and DF had to pay 250,000 to repair this damage. Now you might think that okay, it happened during installation, so this might affect the way that the asset would be in its working condition, right? Because we are thinking about all those costs that bring the asset to its working condition. So if you think that okay, a minor accident has occurred, you might think that this might prevent the asset from coming to its working condition. But if you notice that during installation, a minor accident had occurred, which must have been unforeseen, which the company must not have expected. So, this 250,000 that has occurred because of the minor accident is not the inherent cost of acquiring the asset. It was not within the cost of the asset, that without this cost, the asset will not be in its working condition and will not cannot be brought to its location. Remember, this happened due to an unexpected event, and this cost is associated with the repair of the asset rather than bringing the asset to its working condition and location. So because it is an unexpected repair cost, this cost will be expensed and this cost will not be capitalized. But if it was a kind of a cost that was required for the asset to bring to its working location and condition, then we would have capitalized this cost. So this cost will not be expensed. All right. If the cost was avoidable, which obviously this cost was avoidable, if the engineer was a little bit careful during installation, then this cost was basically avoidable. And if this is a cost which is not avoidable, then you will capitalize it. So basically, why is it expensed? Because it was avoidable cost. If it is non-avoidable cost, which means you have to incur because without this cost, the asset cannot be brought to its working location or condition, then for that purpose, you will capitalize it. But if it was a preventable cost, you will expense it. Remember this. Okay. So let's look at the costs which would be included, which we have already talked about, we have already discussed. So from the initial of the 2 million, we will add these all the highlighted cost. And then let's calculate the present value of the dismantling, assuming that these would be incurred at the end of the 12 years. So let's write down the formula, which is present value is going to be equal to future value multiplied by 1 plus r, which is discount rate raised to the power of minus n. Present value, the future value is 3 million. So 1 plus r, which is 6%. 0.06 minus it will be incurred at the end of 12 years. So the present value will be 1.49 million. Okay. So this is the present value of the dismantling cost. So calculate the total initial cost of the plant. Now, So this is how you will calculate the initial cost. You will have the list price. What is the list price? If you go above, the list price was 20 million. So on your calculators, you will write 20 million plus cost necessary to bring the asset to its working location or condition, which are all these costs which we have highlighted, plus all of these costs. And then you will add the present value of the dismantling provision, which is here. Once you add this, you will get 23 million. All right, 23.09 million. So I'm hoping you might have gotten similar an answer to this one. If you have not, please look at this video again. Try to work through the solutions and try to see where you got it wrong. This was one of the tricky areas where you have to identify whether a cost of such kind of accidents is going to be expensed or is it going to be capitalized. So the way to recognize them is going to be if those costs are avoidable, these are expensed. But if it is a non-avoidable cost, which means a cost that has to be incurred, otherwise the asset cannot be brought to its working condition or location, then you will capitalize those costs. So this is one of the way to remember such tricky points. I hope this session was helpful to you. If you have any questions, please let me know in the comment box below. The next video, we are going to dive deeper into understanding how to carry the asset in subsequent treatments, and we are going to be discussing with more details and calculations. So I'll see you in the next video. Till then, take care and goodbye.